All right, so now we're going to look at the stock market. I'm going to continue looking at things with our cycle analysis, of course, because I don't know any other way. We're going to look at the weekly charts in here that have 1 to 3 month view. If you're interested in the shorter term analysis, we have a lot of people that are writing, that they want to see our daily analysis. That is available to you for level 2 members or higher in FutureSpeak. Where we do 24 different futures of 6 different segments of the futures markets and looking at multiple time frame weekly and daily. So please do watch the FutureSpeak show to get that information. All right, so what are we going to do now? We're going to look at the SPY, and just leaving this gold pattern right over there. And here is SPY and the great megaphone that we're looking at right over here. And cyclical rhythms, you could see the cycle brackets on the bottom. The red percentages are in there about the declining phases. When you're in a yellow declining phase, that is when the 2 cycles are moving down together. We call that nesting, and that's when the greatest risks are. 6.7%, 6%, 35%, 10.8%. Those are when you get declines. And we're not there yet, because we're essentially just now finishing the minor cycle. We have called for decline of some minor amount here in the stock market in December based on this corrective period right over here. I'm going to show you the Russell in a moment. Now, while this really points to a bottom sometime in about a week, the Russell points more to a low around the end of December or beginning of January. So that might mean we're in for a little choppy period right through the end of the year. With the S&Ps right now down 30 points today here at midday, or a little bit later than midday. This is the decline that we were expecting here in the stock market. We thought it would only be in the S&P 500 maybe 110 to 130 points on the downside. And right now we're about 70 something points or 80 points on the downside. So we think it still has more room. Let me take a little closer look right over here for you to see. As we're looking at 1 to 3 months, this looks like a decline in here to about 359 in the S&P 500, and then likely getting another move to the upside, and it would surprise me if it didn't make a new high, because this is a bullishly configured cycle, and it says that the next cycle will make a new high, just like this happened right over here, and it made much higher new high. Our projection on the upside, and here to these fib extensions, is around 371 to about 374, 5, something like that. So that's what we expect, to move down to 359. If this got panicky right now, it would be 351. Which I do not expect, actually. So we'll look for another week or so on the downside in here, find a bottom, and then the bottom pickers, the people that believe you could buy every downside dip, will be in again. And then sometime right over here, from somewhere around mid-January into maybe early February, we make the peak. And then this is that big downside area that we see. We would expect a minimum of 10% down, maybe 20% down in the first leg, as we think that this will be a major top. I'll talk more about that when I do the show, the Market Week New Year's special on December 31st, where I'll bring you the major markets and gold and the dollar, and we'll look at those on a monthly chart and get some sense about what we think will happen in the next year. So you'll want to see that, and that comes out during what will be our vacation time, and I'll be coming back to do that special show. So this is a look at the spiders. We're going to look for a little more downside and then moving up to another high. I just want to look at the Russell, which is the strongest of all of these indexes right here. You could see the cycle brackets on the bottom, the harmonic families that are in there, and the multiple time frames. So when I look at the shorter term, the daily chart, it points to a potential decline out over here into the 4th week of December. That's a little bit longer. So we're going to look for this to actually become a decline of some sort, because the Russell has not been able to move down very much, though it's down over a little over 1% here on Friday. Our target on here is, we'll call it 1810. 1815, somewhere right in there, and then moving up and testing or getting beyond the high. You can see how it hit that fib extension target zone right over there, and then started to back off a little bit. It's been super powerful, made up of stocks that overall don't earn any money. And about 20% of it are what you would consider zombie stocks. Stocks just held up. Companies only held together by the false interest rates that we have right now, and Fed activity, and overall, if you take all of the losing earnings and all of the winning earnings, you barely have any earnings in the Russell. But most of the I think it's S&P 500, Moody's, the ones that give you the PEs on that, they don't even count the losing stocks. They only tell you the stocks that the companies that make money, and that's how they come up with their PE. So the PE in here is just not, it's not even applicable. It's just a super unbelievably high priced index. As you look at this, and we think it's going to make a major top between now and February, and then begin to have a bigger decline. So that's your 1 to 3 month view in the Russell. We'll look for a potential few weeks on the downside, and then taking out another new high before it runs into trouble in this nested area that we're looking at here. And remember, we're talking about a decline out into March, and that's how these line up right over here. So you can see where they lined up over here. Well, you don't always get a COVID collapse like you had right there. Sometimes you only get a mild decline while you're in a bull market. I think this is going to start more trouble right over there in the Russell. So that is a look at the stock indexes. Overall, we're looking for a choppy few weeks, as we see right in here, moving down and then up, and then setting up what looks like a bigger decline in the stock market.